I don't know whether you have been following the Infosys stock lately, but it's going up and down like crazy. Being a blue chip stock and the second largest IT services company, it is not supposed to go up and down like that. The real reason behind the recent corrections in the stock has been revealed by the company's management themselves, which will be discussed in this video. And by the end of this video, the future of Infosys will become clear to you. So please stay tuned and be sure to subscribe for more videos on investing and stock market. Namaste and welcome to Retail Investing. So this is the recent chart of Infosys. I am not much of a technical analyst, but those big gaps on the chart of a blue chip stock are rare events. This became possible because of an announcement by the company's management themselves. The announcement reduced the revenue growth guidance. Previously it was 4 to 7%, but the management reduced it between 1 and 3.5%. So this revenue or earnings guidance is an informal report released by a company's management for its shareholders. The report contains the company's expectations regarding earnings in the next few quarters. It is a forward earnings guide and internal projections for capital expenditure and earnings. As a retail investor, you must have heard of things like forward PE and price targets. Well, these price targets are usually arrived at using revenue guidance. Institutional investors have their research analysts who have their own estimates regarding earnings of the upcoming few quarters. They compare their earnings estimates with the estimates provided by the company in question, and then a price target is reached. In the case of Infosys, a massive mismatch happened between the estimates of the institutional investors and the management's estimates. That resulted in sell recommendations by many analysts. Hence, the stock corrected. Whenever a situation like this arises in a blue chip stock, traders become active and get some success at manipulating the stock. After all, blue chip stocks are not as easy to manipulate as small and micro cap stocks. Closely related to revenue guidance, there is another concept which is worth understanding. This is a concept of measuring a company's short-term financial performance. It compares the growth of revenues and profits of the current quarter with those of the previous quarter. Sequential growth is a useful concept in understanding the current situation of a company, but it depends a lot on seasonal fluctuations and does not affect the long-term growth prospects. In the first quarter of financial year 2024, the growth was 4.2% on a year-on-year basis. Manufacturing growth was 20% and growth in life sciences was 13%. The business in Europe also saw growth at 10%. Operating margins remained almost the same. The new large deals value for quarter 1 was roughly $1.3 billion. The operating margin guidance for financial year 2024 is expected to be north of 20%. So according to the management of Infosys, the company had a very strong first quarter, but the majority of institutional investors expected even better results. So they downgraded the stock. This expectation mismatch happens all the time in stock markets. Stocks often crash even after a good quarterly result. As you can see, Infosys gets the highest share of its revenues from financial services, which is 31%, followed by retail, which contributes 15%, 13% from communication, telecom and media, 12% from energy and utility, 11% from manufacturing, 8% from high-tech, 7% from life sciences and healthcare. When it comes to revenue geography, Infosys gets 62% of its revenues from North America, 25% from Europe, 10% from rest of the world and only 3% from India. So this means any trouble in the BFSI sector in North America and Europe will create troubles for Infosys. As a matter of fact, North America and Europe have been facing big troubles in the BFSI sector since 2022. Infosys' future plan is to transform the company using what they call an AI-first approach. This transformation will happen using 3 technologies: artificial intelligence, analytics, and cloud. So the company is working on 80 generative AI projects. Infosys Topaz is the company's AI-first services using generative AI. There are 12,000 plus AI use cases. For example, e-commerce fraud is a rising menace. Scams are becoming very high-tech and sophisticated. An estimated amount of $41 billion was lost globally in 2022. AI-driven cybersecurity is going to be a big business for Infosys Topaz in the future. Cloud computing is inevitable. All clients of IT companies from North America and Europe have to migrate to the cloud in the near future. Infosys Cobalt is going to facilitate that journey. They also have a center for emerging technology solutions, which will focus on innovation and technology. Metaverse Foundry will focus on future virtual and augmented reality services for clients. Now let's have a little comparison with TCS because they are the main competitor. So the market cap of Infosys is 5.56 lakh crores, which is less than half of TCS's market cap. Infosys is trading at a lower PE than the industry average, while TCS is trading at a premium as always. That means something. Infosys is down by 20% from its 52-week high, while TCS is down by only 6%. Return on capital employed is more than 40% and return on equity is 31.8%. Both are very high numbers, but TCS's return on capital and return on equity are even higher. When it comes to earnings per share, it's 59.1 rupees per share for Infosys. TCS's earnings per share is double that. The PEG ratio indicates that Infosys is at a little better valuation than TCS. But this ratio does not always work. So the cash flow statement is so full of cash. Nothing to worry about that. In the last financial year, the company has generated 37,605 crores of cash flow as profit from operations. The question is, at what rate it can grow in the near future. When it comes to valuations, based on a 2-year forward earnings multiple basis, the valuation of Infosys seems to be at pre-COVID levels. There is a strong possibility that pre-COVID valuations might continue for some time. In that situation, the stock might consolidate for a while. There is usually a high correlation between the performance of Indian IT stocks and the performance of American stock markets. Stock markets in general tend to perform badly when interest rates are high. The American central bank is still hawkish, and it is determined to maintain high interest rates until the target of 2% inflation is achieved. In a very recent interview, the American central bank has said that they don't expect to achieve the 2% inflation target anytime before 2025. Many analysts are saying that this was the last rate hike. I personally don't believe that anybody can predict interest rates. So I am going to take the statement of the American central bank at its face value and assume until 2025, interest rates are going to remain on the higher side. When the cost of borrowing is high, businesses are forced to cut down their spending on technology and other discretionary spendings, which become revenues for IT companies like Infosys. So as a worst case scenario, the Infosys stock might keep underperforming until 2025. But the long-term growth story looks to be intact. Infosys' long-term future may be bright, but not as bright as TCS's future. That's because whatever Infosys is doing, TCS is doing the same on a much larger scale. Some of the deals of TCS are 5 times as large as Infosys's deals. If investors have a 10 to 15 year time horizon, I think TCS has a higher probability of being a consistent compounder and outperforming the index. Now please don't consider any of this as a buy or sell recommendation. This video was only for educational purposes. Don't forget to type in the comment section whether you are bullish or bearish on Infosys. Thank you very much for watching the video and have a nice day. I'll see you in the next one.